Okay, in this video we're going to be looking at how stock markets work. We know we need to invest in equities if we've got any chance of securing an ideal future for ourselves where we'll see out rising living costs. So let's look at equity markets and how they work. This could be any stock market in the world. It could be the UK, FTSE, it could be the Dow in the US. And you can rank companies in the standard way by market cap. And that's a really objective, easy measure. It's just the number of shares in issue times the price. And at one end of the spectrum, you'd have large companies. As you might gather, at the other, you'd have small companies. Okay, and that's really objective. But what you could do is put it on its side effectively and, heaven forbid, put someone's opinion into it, where we started to look, for example, at book assets and looked at the price to book ratios, etc. And on one end of the spectrum, or one end of the axis, you'd have a value company. In other words, the price had so much, a lot of movements in it, it could really do well. Or maybe perhaps it's already happened and you've got large cap growth stocks, okay. And they're the really four defining elements of any stock market. If you look back, again, remember our data set runs back 60 odd years. If you look back at the developed world, large cap markets in the US, UK, have done 10% annualized, year in, year out. That's through good times and bad times. That's through all of the world economic crises that we've seen. And that's just how it is. That's large cap markets. And if you look at small cap, so if we invest in small cap companies, the returns have been 15% and value companies have been 14%. Some people would argue there'd been no premium in value companies for a few years, but again, looking back over a much longer period, we have. So that's really how markets work, and that's what the returns have been. What we do is build portfolios in this north quarter here. We invest into the whole market, so we've got growth and large cap, but we also focus our attention on small cap and value. And that's how we really look at securing premium returns over main market indices for our clients. So what we end up with is the UK market plus small plus value. We end up with the global market, that's the whole market, plus the small cap market, plus the value markets in the global markets. And we end up with the same again in the emerging world. So effectively, that gives us 9 equity funds. We also add to that one global property fund, which takes us to 10. That gives us exposure to the global listed property market too. In my mind, that's better than going out and buying bricks and mortar, having to pay rental or letting agents, stamp duty, legal fees. We can absorb, or really kind of secure, rather is probably a better word, all of the returns from the global property market by just including our exposure within a fund. So that's how we end up. We've also got a combination of 5 bond funds, which are in the main short dated and index linked. We use those to cushion the gyration of prices in equity markets. I'm not a massive fan of bonds. I mentioned in previous videos, if we're going to get 6% from them, it's only going to really keep pace with inflation. It's not really going to do us any massive favours as we go through that 30-year retirement window. So on the gyration of prices, I'm going to move on to that next in video 4. That's coming up, and it's the final part of the series, so don't miss that, and I'll speak to you shortly.